All right, well, good afternoon, everybody. Welcome to the June 8th, 2021 edition of Bull Sessions. My name is Mark Robertson, and I'm joined here by Ken Kavula and Kim Butcher. Say good afternoon, guys.
Good afternoon, everybody. Good afternoon, Kim. How are you doing down there?
Doing well. Hi to everybody out in the audience. We're having another gorgeous day here.
Yeah, we're having monsoons on the way in, so we can relate to some of your Florida monsoons, Kim. It's supposed to be raining here for a couple of days. All right, well, let's go ahead and get underway. I mean, the hats are probably a distraction of sorts. That's in honor of a milestone in the Groundhog contest. We are now 4 months in, 1/3 of the way. So I just use that as an excuse to find some Kentucky Derby attire. You know, one race out of three, 33% of the way through the contest. And I do want to take a moment to express appreciation to one of our friends from Australia. Kelly Buchanan chimed in with the observation that those are apparently cows on our bull slide, Ken. A cow tip, so to speak. I don't know how we know that, and I'm going to get Kelly to expand on that or expound at some point, but chances are we've been going along with cow sessions for the last year or so. I don't know how you figure out the gender of those beasts in the picture.
So I'm just guessing because there's so many of them. They're all together, and some of them are reclining. That it was a group of either steers or cows. But now she's going to confirm that they're actually cows. Okay.
Well, you know, I would have thought that some lifting of tails or some anatomy inspections would be required, but oh well. I am sort of a farm boy, but that one got by me. Anyhow, that gave us the excuse to be comfortable with, you know, the bulls can self-identify as whatever gender they want and wear whatever hat they want, apparently. So good stuff. All right, Clarence and Elmer, that's a reference to a couple gentlemen who started the tradition of homecoming at the University of Illinois back in 1909. In fact, that fourth annual homecoming program is from 1913. One of the gentlemen was named Clarence Williams, and that is on the left, Clarence Williams III. In what was kind of an unusual moment, I went looking for information about Clarence Williams at precisely the same time that all of the notices started showing up on social media that this particular Clarence Williams III had passed away. Really kind of an odd moment, kind of eerie. Probably haven't thought about this Clarence Williams for a couple of decades, and I go thinking about him and then run into that on social media. But he was one of the core elements of the Mod Squad. You happen to remember that show, Kim and Ken?
I remember the show. Wasn't a fan of it, but I remember the show.
Yeah, it went. I think it was 69 through 73 was the time frame for the show. And it was.
I don't date myself with knowing years.
All right. So, again, just kind of a homecoming theme. We're going to talk about the newsletter here for a few minutes, but a lot of the time, you know, when Ken and I get involved, and also Kim get involved in some of these discussions, we find ourselves coming back full circle. Like Ken, I'm thinking of when we were talking about the rule of five and how we discovered. Well, we were talking about our rules for selling, and then it was Ken that came up with it. You realize we're just talking about the rule of five. So I kind of think of that as coming back full circle to some of the time-honored traditions. And that's kind of the spirit that I offer up that homecoming moment with, along with a moment of silence for this particular Clarence Williams III. All right, so we'll give you a quick Groundhog update, spend a little bit of time talking about market barometers in response to some of the stuff we put out a few weeks ago. We have a few comments wondering about how worried, and it's in quotes, air quotes, Ken, how worried we might be about what's going on. So let's spend some time talking about that with some of the stuff that we look at on a fairly regular basis. And then I just wanted to make the audience aware that we have decided to a little while back, we kind of de-emphasized the monthly newsletter, and I'd like to re-emphasize it now. and not just reemphasize it and put it out, but also provide an opportunity on the first Saturday of every month to go through and explore, ask questions, that sort of thing. So we'll just kind of reinforce that a little bit. All right. Here's our standard disclaimer. No investment recommendation is intended. We will be mentioning a few actual stocks. We do try to remember to let you know if we happen to own them personally. But this is all about education and demonstration. We're illustrating the methods and philosophies of the long-term modern investment club movement as we have interpreted it at Manifest Investing, and also as is championed by the National Association of Investors, also known as Better Investing. Please do your own homework and respect the fact that we will be issuing opinions. Don't run out and buy something just because we mention it. We do have a monthly webcast that is on the final, usually the last Tuesday of every month at 8:30 Eastern Time. If you'd like to be added to a reminder list about that event, send an email to nkabula1@comcast.net. If you would like copies of slides, if you have follow-up questions or suggestions for future topics, please send me an email as shown there, markr@manifestinvesting.com. All right. Anything you want to add, Ken, or should we keep rolling?
Well, let's keep rolling, Mark.
We're rolling. Well, there's the bull, or well, that is a bull for sure. The bull has a liberal hat on there, a liberal interpretation of a hat. Here's our standing queue of topics known as the bullpen. We're going to hit those top four here today. Again, talk a little bit about homecoming and the re-emphasizing of the expected returns newsletter. We do have a Groundhog Challenge update, 1/3 of the way through the contest. I think we have a new leader, or we have an old leader reassuming the pole position. And we'll spend a few minutes talking about market barometers that we talk about often at Manifest Investing, our market barometers on parade. And we will get to some of those other topics in future sessions. All right, I'm hearing a lot of this, so I thought we'd kick this one around, Ken. You can find this in a lot of publications, and it's something that they could publish time and time again. It can be repeated. Where it seems like we're getting new all-time highs in many of the major indices, and it's causing a little bit of consternation, a little bit of angst, and I think you're getting cards and letters from people. I know you spent the evening last night with an investment club. Were they having any of these type of concerns?
The club last night has a deep history, and the members are extremely experienced, and I didn't sense any worry, any pain. They made the point that they're having a little bit of difficulty identifying stocks to purchase, but they're also completely comfortable with staying within their own portfolio and adding to it when the opportunity is there. So they have 15 or 16 stocks, and it's a wonderfully constructed portfolio, sitting with future par values 6 points above average right now, 6.5 points above average. So that's all in all, this particular club understands the ups and the downs of the market. And I don't think that they're going to tend to get panicky no matter what's happening.
Okay, that's what we like to hear and witness and be a part of. Good stuff.
Yeah, I would guess this club has probably 45 years of existence.
Mm-hmm.
One of our clubs from the Midland area, and there's a huge number of older clubs in there, because that's one of the first places that Tom O'Hara kind of a la Johnny Appleseed went up and helped people put clubs together. He knew that there was a large concentration of college-educated people up in Midland, Michigan. That's the home of Dow Chemical. And he took advantage of the fact that not only were there educated people, but there were a lot of people with resources, and put a lot of clubs together up there. And we still have some of them in our chapter that are 60, 65, 70 years old, which means they go all the way back to the beginning of the association.
Yeah, I can remember similar stories about Indianapolis and being specifically targeted as the outreach campaigns began outside of Michigan for some of the same reasons that you just mentioned. Yeah, good stuff. All right, well, here's a look at the S&P 500 over, I think this is 40 years-ish. And I guess my point would be there's a whole lot of all-time new highs on that chart. More than I care to count. It's not an unusual thing. We do go through periods when they happen less frequently, as in the last decade in the middle of the chart. But in a normal functioning market, we ebb and we flow. We go in non-linear, not straight lines between point A and point B. But the setting of new all-time highs is certainly not, it certainly is man, dog bites man, right? Type of news. I guess the one observation I would make before turning it over to you for any observations, Ken, is one of the things that I think is becoming more characteristic with the market and with the expansion of information available to everybody. You know, you go back 20 years and in the average investment professional, including the brokerage industry, didn't have as much as we have as our fingertips now. And that has exploded. And basically down at the bottom, what you're looking at is the volume of stock traded. And I do think that going forward in the future, that type of spiky, highly technical term, spiky volume can be a sign of concern. Because when a nation of investors, and I'm using air quotes again, starts running for the hills, it can get awfully nasty. So just something to think about. I would draw everyone's attention, and this is not just a summer thing, this is a long-term chart, that characteristic of high volume is certainly not present right now. Your thoughts, Ken?
I'm going to unmute Dwight. Dwight has had his hand up for a while, and let's see if he wants to contribute a comment or so. Dwight, you'll have to unmute from your side if you want to speak to us.
Aloha.
And that must have been an inadvertent hand because it went down real quickly with no unmuting. So we're all set there. What I'd like to point out, Mark, and maybe you're going to go there, are the times when the relative strength index has moved above 70. It's kind of dark on the graph. They've shaded between the 70 line and wherever the graph happens to be, they shaded that in. And it happens on a relatively regular basis. Now, they don't last as long as the late 90s. I think that's probably the only true bubble on the entire chart. Would you agree with that, Mark? The run up to the late 90s there, the tech bubble.
I think you're absolutely right. I think from 96 through the year 2000, we had a major incident in the middle of all that. You can actually make it out here a little bit with the long-term capital management. But outside of that incident, you basically had the S&P 500 and dominated by a few key companies like Cisco. Actually went nuts for a few years, and it actually did finally reach that level which led to the lost decade. And Ken, I'll go ahead and draw in your definition of the lost decade. I mean, the stock price basically went.
When they were talking about it, that's what they were talking about. 2000 to 2010, where you kind of rode the market up and down, but you didn't get anywhere. That was the point that a lot of the talking heads were trying to make. The point that I want to make on this is, if I'm not mistaken, Mark, this chart is based on monthly inputs to the data. Is that correct?
That's correct.
Okay, and I just want to indicate that that's not the easiest chart for the non-subscriber to draw using either stock charts or big charts. That you have more access to charts that run daily or weekly rather than monthly. And these charts look very different depending on how you draw them. When you pull your data in, you won't see nearly as much oversold kind of stuff as you're seeing on this chart. If you look at shorter term charts that are maybe drawn day by day or week by week. So make sure that you're comparing apples to apples if you're trying to pull these charts up yourself. This is based month to month, and Mark does have a subscription to stock charts, so he's able to draw this complicated, if you will, or this more detailed graph. And if you're just looking at a free subscription, you don't have that same access and everything. I also want to make the point that every time it goes above does not necessarily mean that you're going to have a sell-off or a dramatic sell-off in the market. I mean, it does happen occasionally, but at the same time, it's just as likely to kind of hit a plateau, especially if it pops up and then pops back down again, just as likely to hit a plateau or to slow down as far as growth is concerned and let everything kind of catch up to the whole process. Am I worried that it's gone over at this moment? No more worried than I was in the 16, 17 time period, or the 13, 14, 15 time period, or the 7, 8 time period, or any of these periods when it's popped over the 70 line, and it's not abnormally over the 70 line compared to these other things right now. Looks like some of them moved actually up to the 90 line, didn't they, Mark?
Yeah, a couple of them did actually sneak into that threshold.
Yeah.
Well,
So it's not a chart for panic. I guess that's what the whole thing comes down to.
Yeah, the one thing there are a couple things that jump out. I just made a note to myself to look at the equally weighted S&P versus the one that is overweighted in the large few companies at the top, just to demonstrate something at a future bull session. But the other one, you guys have heard me talk about this a number of times. Back in this time frame, when we had the 50th anniversary of the National Association of Investing, I'll give the nutshell version now. Ralph Acampora basically stood on a stage in Detroit and said, index investors, especially S&P 500 index investors, are about to get killed. And his message to our audience was, you guys are the ones doing it right, because you're still out there picking companies and avoiding some of these that have really been high flyers for a number of years. Their upside downside ratios were quite low. Their projected annual returns were quite low. And, we basically recognized that and did more shopping amongst the medium-sized and smaller, faster-growing companies during that time frame. Fast forward 10 years later, we basically came out with buy the deepest of the deep blue chips, and that has worked out pretty well. The answer to the question as to whether or not there's any cause for concern now actually does come down to a dashboard on the S&P 500 not looking too bad. It doesn't look extremely attractive, but it also it hasn't flipped the other way. So just a few things to think about. Again, any one indicator taken by itself, probably not the best idea. On this chart, I see a high relative strength index. That gives a little bit of angst, but it's offset by the low volume at the bottom. All right, here's our favorite indicator. This is one that Ken and I kick around regularly. You can see that the Wilshire 5000 has reached new highs. You can also see that the median return forecast at Manifest Investing has stabilized in that 6 to 7% range. It's not unprecedented, and again, it's just in an area where I might dial up the hunt for quality or the hunt for financial strength a little bit, but literally not changing anything that I would be doing traditionally. Any thoughts?
Well, and Mark, we get so used to watching graphs on log paper when we do SSGs, when we're looking at earnings trends and sales trends, that we forget when we move to regular graph paper, the kind that you used in high school. that consistent growth doesn't graph as a straight line on regular graph paper. Consistent growth graphs as a curved line. So that has to be taken into account as well.
Mm-hmm.
You know, you're not looking at a you're not trying to measure whether the growth in the stock market is consistent or not. If we were, we would have to put this on a different scale to make the whole thing make sense. And my gut feeling is that probably we'd get some consistency around a 10% growth rate if we were to put this, maybe put even more history onto the graph than we have here.
I might tinker with that and see if I can confuse the audience even more than in the past. All right. Here's that second indicator. This one is also on linear, regular graph paper. And there's that curve you were just talking about, Ken, through the points. But this happens to be a similar indicator. This is the value line companies, and it's the median appreciation projection that's in the forecasts. Again, the thing to point out is although we're at levels that are, you know, much like the minimums or the lows on this chart, still not dramatically, you know, out of bounds in terms of being way lower than anything we've ever seen. So nothing terribly dramatic there.
And the only lesson that we've learned is that over most of history, those times when the green bars have moved above the blue line, they've come back to the blue line. And when they've moved below the blue line, they've come back to the blue line. There was a lot of space below the blue line for a couple of years there. And now we're seeing that space above to kind of balance out that time period. That's what makes for relatively consistent growth. And that's what gives us that relatively decent progression of the blue line upwards and to the right.
Okay.
Well, and Mark and Ken, as I like to think, everything reverts back to the mean eventually. And so if you look at your stocks and you see what the high is and what the low is and where the medium is, you kind of like, you look at it and everything reverts back to the mean.
Yeah, and in fact, we take it a step further, Kim. We like to think of it as regression to the trend as opposed to the mean, which could be a misleading situation. So yeah, it's the same type of thing, same philosophy, but regression to the trend.
Right.
That's the fit. All right. Here's a quick look. Well, this actually came up on Saturday morning. People asked for another quick look and discussion of it. This is a 50-year chart of the value line median appreciation projection, just to make the point that that number does move around. We are operating near that red box, those red box levels. So yeah, that, you know, a little bit of concern, maybe a little bit more ratcheting up of quality and financial strength, but you know, not anywhere near panic mode. And the other thing that I like to point out, if you're not a person that's in capital preservation mode or near the end of life expectancy and you're still a fairly young person, especially if you're earning income and still putting away money with cash flow going into an account, I just point out that look at, you know, how much that's moved around over the years. There are times when we thought that the stock market was going to go down for the count or whatever. I mean, point number one there, you had the oil embargo and the advent of a gruesome inflation back in the 1970s. You had a number of other incidents going on in the 2 and 3, out in 4. That was right around the time of the first invasion of Iraq and some of the stuff that went on. Just off the graph to the right is the Great Recession. So, you know, you can make a laundry list of things which were seemingly catastrophic for the stock market, but it really just is a matter of weathering the storm and getting out there and finding better companies at better prices. We'll be talking about that in much more greater detail here in a few minutes. So one that's an audience favorite chart. Thought you might enjoy seeing that one come back to life, Ken.
Yeah, I like to get this long-term picture, especially since I'm at the left side of most of these long-term graphs now. So
All right. Let's just talk about a couple other indicators that we would take a look at least with one eye closed and the other one squinting, perhaps. This happens to be the Morningstar fair value for all of the companies that they cover, and it is tracking at overvalued. I mean, we're up above the line, but again, there have been a number of times, including a year ago, just before the downdraft, and then just a few years ago when it did seem like we were in a bit of a recessionary condition, and then launched out of it, and then back in this time frame here, the opposite, following the impact of the Great Recession, you basically had virtually everything on sale back in this time frame. It was a true back up the truck moment, and many of us actually benefited from that moment in time. So again, Morningstar not showing any tremendous indication of being overvalued under present day conditions. All right, let's look at one more. This one probably gives a few of you a bit of a headache, but I find it fascinating. The nutshell version explanation of this is a presentation that Barry Ritholtz and a couple of technicians gave several years ago, where they talk about how a large correction in the stock market basically doesn't generally happen suddenly. The ones of the worst kind don't happen suddenly. It's more like watching the leaves fall off of trees in the autumn. And they actually went through and made this example, and they talked about how all of the names that you hear about on the nightly news, they just suddenly stop putting in new highs. And if you're tracking the new highs versus the new lows, that's the picture that you end up with here. The blue line is basically a long-term trailing average of the new highs versus new lows. And again, I'm coming at this from the perspective of, well, what are conditions right now? Conditions right now are not that bad. And I got to tell you, that I actually credit this image. I don't remember exactly which dot it was back in here, but somewhere back in here, I don't know which one it was, somewhere in here, everybody was at all these money conferences and everything else, basically talking about the world coming to an end. And my dad actually caught some of these guys, and he's writing all these notes down and asking me all kinds of questions, and they expected Armageddon or something. And I got out this chart back in this time frame, and I'm like, Dad, we continue to still go for it. Things are chugging along pretty good, and I credit that with making a huge long-term difference in his investing efforts over time. So I like to look at this as an indication of what's going on in the sentiment and the flow of the market. When you go back and you look at the nastiness, which started back in Halloween 2007, again, this slow decay, and then it's more the volume of this box right here that's a problem, and how it really decayed and it lingered for quite some time, finally ending in March of 2009. And these spikes bother me less. Now this, I think this is just an outlier. I don't even think that belongs on the chart. But in terms of characterizing or how I look at the market in terms of, Mark, are you ready to panic? I look at this and my answer is, I don't think so. So it's an interesting chart. Again, in order to see some of the nuances and just kind of experience what this is actually showing, I would refer you to that discussion from the Manifest Investing Forum. It's from several years ago, and it describes, what you're looking at there. I don't do it justice. Any thoughts, Ken?
well, yeah, and the biggest one is that they hardly ever stay down there, and when they do, you have a good reason for deciding that you have a little bit of time to make decisions. That's what makes 2020 so unique in my mind from my own history of investing. When times were bad, in all the other bad times, and my investing career goes back to the early 80s, when times were bad, you always had a little bit of opportunity 6 months, 9 months, a year, maybe even a year and a quarter or a year and a half to pick up some really decent stocks. I mean, when the market crashed in 2008, you had a full year or more to examine and decide what it was you wanted to buy. In 2020, you better have watched and not carried even as much as a day in some cases, or you lost the opportunity. I think that's why you remark that this is truly an outlier. It's truly a whole different class of something going on, and it's and we know what went on. So we know that if we hadn't shut everything down, we probably would have had terrible contagion happening. But at the same time, we know that we created the problem for many companies, and it was there, and then it started to go away pretty quickly once we started to pull things back together again. So I agree with you, Mark. I'm not overly optimistic at this point, but I'm certainly not in the camp of thinking that we're headed for gloom and doom in the next 3 or 6 months.
I agree. Okay, let's go ahead and wrap up. And I mean, the situation is, as shown by the chart, which has driven a few of you crazy, the reality that there aren't many stocks in the buy zone in the way that we have constructed our buy zones, much like the stock selection guide on all of the stocks in the Value Line Investment Survey. There's a bunch of them in the hold, a bunch of them in the sell range. We have seen a little bit of a drift more to the hold here over the last couple of weeks anyhow. But the one thing that kind of captures all of this, I mean, the Value Line Arithmetic Index, that's our all of the above average, again, going back, in this case, 30 years. This is a pretty special time that we're in. There's no doubt about it when you look at the right-hand side of that graph. But again, I would compare that to, it's not a heck of a lot different than what I'm drawing in the middle of the screen there. Again, the rebound coming out of the Great Recession was not dramatically different. I mean, the slope is virtually the same. It may have been a little less sudden and dramatic, but it's certainly similar, mathematically similar from where I sit. And, you look at what happened after this point in time. I can envision something like this, filling in going forward from now. So that sort of thing. And I'll close and turn it over to you guys. The profitability thing that you see here, this is coming to fruition. And around a bonfire this last weekend, in fact, I wrote about this on the forum, that a major mortgage company is actually staffing up in great earnest to handle foreclosures, according to what their economists are looking at. And that's kind of a chilling thought. I'm not sure I understand or agree at this point, but it just simply is happening. And around that same bonfire, we were talking about all the stuff with the government money flying around, and just a number of topics, tried to avoid the politics so that people would remain reasonable. And I just made the observation to say, you know what, our water heater failed a little over a week ago. And it took us several days to get, a plumber to respond because they're so busy. And then when he did respond, it took him up to a week to find what I think, in fact, he had to go up into your neighborhood, Ken, to find the water heater that matched the one he was taking out. So, we were without hot water for 7 to 10 days. And I think there's a lot of hot water heater situations out there where you're going to see the economy restored, but in increments and, with kind of a staggering, if that makes any sense, rather than this big rush. No difference than when the restaurants reopen and they go from 25% occupancy to 50 to 75. So it will be like an easing back into this. And there's a lot of pent-up demand for inventory and services. And some of that's going to be staged by the ability to supply and meet those needs. So that's kind of my outlook. I don't see it as something as abrupt as running out of toilet paper a year ago. Your thoughts?
Yeah, I can also say that here in the condo, people who have bought a condo and they're remodeling, number one, it's hard to find a contractor to do it, as you said, Mark. But when they want to, redo the kitchen, they're telling them order their new appliances now because they don't know if it'll be 6, 8, 10 weeks. And if they're from, like Samsung is from Korea and the other places that are building them, they have no idea when they're going to come in. So order them as early as you can. So I agree with that fits and starts, because you don't know when things are going to happen. And we know that the semiconductors, there's not enough chips for memory to do things. So that's another area that could, impact people.
Absolutely.
All the chip memory and all that. And I was reading, I was reading that the only person that Charlie Munger has let manage some of his money and invest it was Lilu, Lilu. Very interesting enough, you looked at what he had in his last quarter 13F filings. 51% of what he owned was Micron, a semiconductor.
That's a pretty focused bet, concentrated bet.
That's pretty focused.
Yep. Your thoughts, Ken?
Mark, can you go back one slide? We have a question. Somebody's picked up the EMA over here in the upper left-hand corner of the graph.
Yes.
Can you tell the audience what EMA is tracking?
Yeah, that stands for an exponential or smooth moving average. So what you're doing there is the data that is graphed in these green and reddish areas, or brown, depending on how it appears on your screen. What you're looking at there is a 12-month trailing average of those numbers. So rather than look at any one point, you're looking at a 12-month, it's called a moving average, but in this case it's a trailing average, just so that you're paying more attention to the long-term trend with a lot less of the zigzag fluctuations. Okay? All right. And your thoughts, Ken?
Well, I don't want to belabor the points, but I'm confident that the way we're moving out of the pandemic is not going to be nice and linear and smooth. We didn't move into it in any rational way, and I think we're bound to find irrational things happen as we move out, and a lot of it, I think, is unintended consequence. We push somewhere, and we expect something else to respond to that push, but it's more like a water balloon where you push somewhere. Sometimes some other place is the one that moves out and breaks on you, and then you have to make it all work in a slightly different way. I just think that you can't expect to come out of this in as smooth a way as a lot of people expect that we're going to do. I think all of this stuff with us seeing so many jobs going begging, and at the same time hearing about so many people that can't find jobs, I think that all of that has to do with unintended consequence, and it has to do with people rethinking what it is they want to get out of a job when it's all said and done. You factor into it all the money that's floating around. You factor into it all of the facts that the second largest generation is retiring and the largest generation is taking over, and that the two generations have different thoughts about what makes progress, and they have different thoughts about what's good and what's bad for the economy and for the nation. And to expect it to be smooth is, I just think it's for a fool to expect it to be smooth.
Yeah, I mean,
I want to look. I want to look back on it a year from now or 2 years from now, and I think that'll give us a better picture of how we managed to move from where we are today, or maybe where we were 6 months ago, to where we'll be in 2 years.
Yeah, and I just circled the point on the middle section in the graph and would ask the audience, why would you expect that to be smooth going forward? I mean, there's no evidence that that would ever be the case. All right, let's do a little transition here. The Groundhog, this is an important addition to the Groundhog. It's a milestone moment, but it's also a really magic moment because of this. I did make it back onto the list, Ken. You're handing
I noticed.
25.
I noticed, yes. Uh-huh.
And Joseph did sneak back into the number 1 spot. The numbers are going up. These are both higher than they've been. Kathy is still not going up, but a lot of very familiar names on there. Anytime I'm hanging out with Anna Gombar, I feel like I'm in good company. She's a 2-time champion of this contest, and there's just a whole bunch of familiar names. We can't wait.
You're hanging out with Bauer City too, Mark.
Yeah. Well, anytime if you're in there with Susan Michelik, you're doing well.
You're down there hanging out with the smart women, and maybe something's rubbing off. I don't know.
Hey, and we've got 8 months to go here, and Kim, we might even see you.
Yeah, exactly. I'm thinking 8 months. I still have a chance to get out of the top into the top 100.
You're in the top 100 now. I'm pretty sure.
Well, okay then. Maybe in another 3 or 4 months I'll get to the top 50.
There's hope.
Then at the end I'll be in a neck and neck run.
All right.
I want to answer the people that have written to me, and probably, Mark, I don't get nearly the mail about this contest that you do, but I get mail occasionally. Somebody's referring to their portfolio that's been posted in various places on Manifest, and they notice that they don't have any shares of something and that they have cash in their portfolio. And I just want to re-emphasize the fact that cash is an estimate of what those shares that don't have a price attached to them right now might have been worth at the beginning of the contest. And as Mark gets further and further along and gets coverage on some of these more exotic things that some of you have placed in your portfolios, those dashboards are going to be more and more accurate as to what it is you're actually holding. But if you have 3 or 4 of your 12 or 15 holdings that have zeros right now, and you have a big wad of cash, that dashboard might not be as accurate as you think it is right at the moment, at least.
Yeah, and I guess the point that I should make is every single one of these is real time adjusted for the real prices. So obviously we're going to be tracking down any variances and fixing those, but we do need for the next wave of our software to be in place to do that effectively. All right, moving on. Just a little bit of moment with homecoming. Just wanted to make a note that there's an awful lot of stuff at Manifest Investing. I would encourage you to use these 2 functions. The one down by the ticker symbol down here, this is kind of like our Seeking Alpha thing. If you use this looking glass or magnifying glass, you can actually dig into articles that are specific, either published articles or forum posts specific to the company Regeneron at Manifest Investing. And then if you want to search for a broader topic, just encourage you to use the site search, not the stock search and not this individual company specific function, but the general search in the on the home page in the navigation toolbar. And I also wanted to make the point that I had a blast this past weekend as I was preparing for some other stuff that's going on. If you actually use the YouTube Manifest Investing channel and you type in roundtable, in this case I was looking for Regeneron type stuff with the ticker symbol, you actually end up with these 2 entries at the very top of the chart. And then there were a few more that trailed off after that anytime that we would have talked about Regeneron during a roundtable, but you can actually dig in and go back and look at the presentations. These were the 7 times that we've actually selected Regeneron over the last several years, and I was able to go in and find, here's the most recent one from March 2021. There's Kim and our going to the moon rockets. And then this investing roundtable from May 2019, which is kind of interesting because this was the cover. It's one of our more infamous covers over the years. Again, dating the moment back to the Game of Thrones end of the series, and the time when Kim had long flowing hair. But
my hair's longer than it's ever been since high school right now. It's never that long.
And then you could actually dig back in, retracing, again, using that search function to go back and see what I had to say about Regeneron back in May 2019, the presentation that I made, along with some of the backup documentation that was made for Regeneron. And as the same point that I made on Saturday morning, I'll make it again now. I'm always fascinated by when I'm getting in a little deeper with a company and assuming a role of stewardship as an owner of the company and really trying to figure out what's going on. I just want to say I am greatly impressed anytime that I can go back and take a look at what a company said they were going to do and then sit here for the next couple of years and watch them do it. And that's the case with Regeneron. It's impressive. I've seen this happen a few times over an investing career. Now, if they're not doing what they said they were going to do, they sometimes will have a legitimate, justifiable reason for doing something differently. But again, you want to be aware of that and understand what's going on. And this one's had a pretty good run. And here was the other slide that was used just to make the point that these guys are digging into a number of key areas, from dermatology to asthma to cancer, skin cancer on the upper right, the stuff that they do with macular degeneration. Anyhow, there's a whole bunch of stuff that they talked about 2 or 3 years ago. Much of the stuff is coming to fruition now. And I know, Ken, you recently featured it. Any thoughts from 3,500 feet on Regeneron?
Well, yeah, we got a lot of questions, Mark, about Regeneron's income stream. And we talked about it in a couple of different places after those questions came in. But I just want to make the point again that if you're trying to deal with revenue for this company, you must be aware of the fact that a lot of the revenue for Regeneron comes through partnerships with other drug companies. That's very important for you to understand because Regeneron does a lot of partnerships in order to take some of these drugs and make them worldwide in distribution. They don't do the worldwide distribution themselves. So you have to look at the revenues coming in from the partners as well as the revenue coming in from Regeneron's own direct sales if you're going to really analyze this company in any way, shape, or form.
Yeah, and one of the more common questions I get on this one, forgive me, I don't remember the 2 major competitors that they have, and they are losing some patent protection. But the comment that was made to me by a pharmacy expert, and he actually ran a number of pharmacies, was that's not exactly a new condition. Those competitors have been there for years. So, it's not like something that's unfolding that's greatly new. And then the other thing that is true is these guys are actually doing some crossover stuff, like taking stuff that's working in the treatment of dermatitis and extending it into asthma. And there were a couple other examples of that. So they are deploying proven solutions in different ways, and that can have a very extending benefit to a company like this.
And Mark, especially the kind of asthma that they're moving Dupixent into, there's a whole series of articles by some pretty knowledgeable people that indicate that moving Dupixent into pediatric asthma, that's asthma for young children, obviously, and moving that drug into that treatment will have profound effects on the health of children. Pediatric asthma is one of the most common serious ailments that children have. and finding a way to deal with that so that you're not running to the emergency room 2 and 3 times a month can be a game changer for parents and for their children.
Yeah, and I guess the other thing I would point out is, this one's a big one down here, COPD. They're making significant progress in places like that, and some of the talk about pediatrics, Ken, and allergies. Probably time for an update at a future roundtable as to what the specific progress that's being made in some of these FDA trials. Anyhow, the long story short, it was the 500th selection or decision made by the roundtable, and it was made by the audience back in that time frame. So it's kind of fun. There's just a quick look at the current state of the company as goes. All right, let's talk about homecoming.
Well, we should be clear, Mark, that the other 2 stocks that were chosen at that roundtable, since I own both of them in clubs and personally, they weren't slouches either. Whoever chose Air Lease and whoever chose Schwab, those were pretty decent choices, as well as the Regeneron choice.
Yeah, if you look at our track record over the last, especially 5 years, it's staggering. It's good, clean fun.
I'm curious, Ken, what did your club decide to do about Schwab?
That meeting is this evening.
Oh, all right. I'll look forward to next week hearing what's going to happen.
Update. All right, here's your 1913 program. Again, just a reminder that we are going to begin doing these on Saturday mornings. Kim and I had a real nice time with the audience this past weekend. Again, it's an opportunity from our perspective for you to see what's out there and get some questions answered and help fine tune me. I'll take all the help I can get when using power tools. All right. Just a reminder that we covered stuff like this during the session on Saturday morning. These are the companies that were selected during the recent stock panel. Ken, I did go ahead and create the dashboard for these, and that's in the notes in the forum. I'll show where that's at as we wrap up here. And here was some of the feedback that we got. I like this because it makes me feel good, and I'm very grateful for all of you. And I do want to disclaim that 4th one down there was not sent to me by a family member. And yes, those slides went out immediately. And I love Hugh's quote that the next time we do this, I do think there will be a next time as soon as Ken has recovered from the last round. The next successful investing conference will be the canceled COVID conference, number 1. All right. So let's kind of close up with
Mark, I want to emphasize that these Saturday sessions that you're running are free, and you can get the registration material right on the Manifest Investing website. Just look at the front page and look in the upper right-hand corner under Events, and there'll be a place to click right there. What are you billing them as, Mark? Saturday?
We're just calling the webcast version of expected returns, first Saturday morning of the month.
First Saturday of the month.
So we should have decent progress made.
Tracy, if you're looking, you just have to go to the web page. Well, there's not one listed right yet, Tracy, because they just finished one, and the next one's not coming till the first Saturday in July.
I will create an event opportunity for that after we hang up here.
And then, Mark, before we move into our wind-up kind of thing here, Dwight would want to know, do you know the return of the last place Groundhog in the contest?
Yes.
Could you share that with the audience?
Well,
as long as it's not my name.
The worst performing Groundhog, Kathy's next to worst, but the worst one is at minus 30%. That's actually a fairly recent champion, Curtis Sears. So if you look at Curtis's dashboard, I don't know what stock has gotten him in trouble, but Curtis has had a couple magnificent years, and it's just a reminder that humility continues to reign true in the stock market, as reliable as gravity. All right. Anything else, Ken?
Well, I love the additions that you made to this slide, Mark, this economic drift slide. I love them.
All right. Well, here, let me kick off the topic. It's something we used to watch more carefully, and here over the last few days, I have kind of re-engaged to that also. And you'll see why we're doing this here in a second. But this notion of, if you can actually go back and revisit this crossing the chasm presentation that you and I did a little over a year ago, Ken, as we got into this stuff. I love the road sign on the upper left. It's just this notion of when things happen, either events or just general environment driven distortions or disruptions in the behavior of a stock price. We're looking for a bridge. And I think that our discipline, our 8 decades of discipline at doing this, give us a pretty powerful answer. And I'm going to define the economic drift for you here in a minute, but as I was talking about this, Ken was reminded of a bridge in his neighborhood.
You all know that I live in Michigan, and Michigan is really 2 states. We have a highly populated southeastern corner, and then we have a lot of forest and farmland that goes all the way up and meets the state of Wisconsin as far west as St. Louis in the Upper Peninsula. But that's all held together from Sault Ste. Marie down to the Ohio border with I-75. And I-75 is a 12-lane parking lot on Fridays going north and on Sundays coming south during almost the entire year, because of all the people that move up north for their second homes, their cottages and everything. Well, when we first moved to Michigan, my wife and I, we were struck, flabbergasted by the fact that not only were all these people moving north, but that there was a drawbridge over the Saginaw River that would open every 15 or 20 minutes and therefore back up traffic all the more on I-75.
Wow.
Well, about 15 years ago, they decided to replace that drawbridge. And on the right on the bottom, you can see the high-level bridge over the Saginaw River that has replaced the drawbridge. Why do you need a high-level bridge? Because Saginaw has a lot of barge traffic, and the barges need to go under the bridge to get to Saginaw and unload whatever it is they're carrying. Well, on the left is a picture of what happened. They started to build this bridge from both sides, and they were confident they were going to meet. Well, they got to a certain place, and you can see what happened there. Those 2 pilings are not even smooth, horizontal to each other. One is lower than the other, and there's a good, Mark says it's 4 feet, but even this picture looks like it's 6 or 7 feet to me. But the problem was that all the civil engineers in the world couldn't get the 2 pieces of the bridge to match. And it certainly was an embarrassing thing for Michigan's reputation. And it took a long time to rejigger and refigure how they were going to get these 2 pieces of bridge to finally meet. Today, it's an easy commute up to the northern parts of the state, and the bridge acts just like it was intended to. But the tolerances evidently weren't small enough to get the bridge to actually meet with its mate from the other side of the river when this was first put together. So we're talking about economic drift. Let's bring it back to the point of economics here.
I'm just thinking, what speed you have to reach to make that jump.
Well, going in one direction, if you're going to go down, I think it's not so bad. But boy, if you have to not only hit 6 feet, but you also have to go up 2 feet, I think you got a real problem there. Got to build some ramps maybe. But why don't you get into economic drift there, Mark, okay?
All right. So what it comes down to is I really believe with all my heart that the tools that we have, the stock selection guide or any stock selection guide centered analysis of any company, offers us this solution to the challenge of a chasm. And we've now, Ken, I'm actually sitting there thinking about some of our discussions from 2008 as that chasm began to develop. And then obviously a year ago, some of the discussions that we had. And Ken and I will both confess, if we're being honest, sometimes these are not easy discussions to have when we're talking about opportunities from down at the trough of one of these chasms. So I'm going to define economic drift for you. And economic drift is basically because of whatever's going on with this particular company. You can see that the sales trend based, straight off the stock selection guide, the sales trend is up here, cranking away. And then whatever happened in the economy or whatever, or world, or, whatever the economic or environmental conditions were, the sales actually got tanked down to this trough, down at the bottom, and it's way off the trend line. So we can basically calculate the difference between that trend line point and any point on this actual sales curve. And what we have done in the Manifest Investing database is basically restored something that we used to do all the time. It was extremely necessary back in the 2008 timeframe. I'd kind of forgotten a little bit about it, but it's kind of a notion of homecoming. Anytime this gap exceeds a certain amount, we basically go ahead and substitute in the trend line. So the long-term trend established by the company, because it's our belief that this company is going to track back to there over the long-term perspective. So we do have, I was being kind of hit or miss with the database, putting it bluntly, and now we're back to a more scientific approach to identifying the companies that have that large differential between the 2 points. So we actually can quantify it, and we can actually detect it and then actually deal with it on a company by company basis. And it doesn't make a big difference to the large amount of data in our database, but a few companies were being impacted by this. And the interesting thing for me, Ken, is that what it did in a very large way is reconciled the projected return on value with the par values. Actually, the par values didn't go up that much, but the projected return on values did.
And that was our gut reaction as to what was going to happen anyway, wasn't it, Mark?
I think it was. I don't think we expected it to be quite that much. We are now where they're within striking distance of each other.
And we were kind of hoping that one would readjust. We weren't quite sure which one was going to readjust, but that one of them would.
Yeah, and part of the reason for that, the driver behind that, was we began looking at projected return on enterprise value right as this hit, right as the chasm began forming, kind of like a sinkhole. So just that's the situation. Watch for it. Anytime you see a weird number, it's probably weird for a reason. All right. Any other thoughts, Ken?
Nope. I love that slide though, Mark. It's a great one.
We'll be coming back to that slide. That won't be the last time you see that slide. All right, here's your reminder. Here's your reminder to the audience that all of the sessions, or both sessions, roundtables, and our conferences are available. And now the Expected Returns monthly webcasts are available at the Manifest Investing page on YouTube. Those are the 15 sessions, and they're at your fingertips. Please go there. We would greatly appreciate if you would subscribe. That would help us out in a big way also. And we'll leave it with Lincoln Williams III and the Mod Squad. And that expression that comes back from the early 1970s, solid, keep the faith. So with that, I think we can go ahead and sign off, Ken.
Sounds good, Mark.
Thanks.
We can remind folks that you and I are going to be speaking at virtually in Northeastern Ohio in September. And if you're looking for a class that we're going to be doing, you might want to stick on your calendar September 18th. We will be doing a presentation in Northeast Ohio, and I'm sure those folks would love to have part of our audience attending what they're presenting as well.
Okay, so with that, good afternoon, everybody. We will stick around and take a look at a couple of things. I've got a couple notes here.